Hello, my dear students. A very warm welcome to all of you in Shri Jayendra Rank Zone. I am your friend and mentor for the subject Principles and Practices of Accounting. In this lecture, we'll continue with Accounting Chapter 4, that is Inventories, and basically, we'll begin with the theoretical questions. This is lecture number 9. Let us resume and let us begin. Theoretical questions. Number 1. Write a short note on adjusted selling price method and determining cost of stock. Adjusted selling price method of determining cost of stock. Let us do it. This is question 1. Adjusted selling price method. Adjusted selling price method. Take a note along with me. According to Accounting Standard 2, according to Accounting Standard 2, this method may be used in retail businesses or in business where the inventory comprises of the inventory comprises of the item items the individual cost of which are not readily ascertainable, not readily ascertainable. Next, the cost of the inventory, the cost of the inventory is determined by reducing the estimated percentage of gross margin from the sales volume of the inventory, sales value of the inventory. Next, the calculation of the estimated cost, the calculation of the estimated cost, the calculation of the estimated gross margin of profit may be made for individual items or groups of items or by departments as may be appropriate to the circumstances. to the circumstances. This method this method is also used by some manufacturing organizations for for valuing the inventory of finished products of finished products held against held against forward sale contracts. Okay, so let us continue. The next question is principal methods of ascertainment of cost of inventory. Question number 1, 2. Principal methods of ascertainment of cost of inventory. Question number 1, 2. Principal methods of ascertainment of cost of inventory. Cost of inventory. There are 4 accepted methods of costing inventory. First, specific identification method. Specific identification method. Second, first in, first out. FIFO. Third, last in, first out. LIFO. And fourth, weighted average method. Weighted average method. Each method has advantages and disadvantages. Note that a manufacturing business inventory will consist of work in progress and unfinished stock of goods and finished inventory the cost of unfinished and finished inventory contain a combination of costs related to raw materials, labor, and overheads. On the other hand, on the other hand, a retailer's inventory consists of all finished products purchased from a wholesaler from a wholesaler or manufacturer manufacturer. The cost of their units are based on the cost of their units are based on their acquisition cost rather than rather than the cost associated with manufacturing units manufacturing units manufacturing units. Right, the first method, that is specific identification method. Specific identification method. The specific identification method, the specific identification method of inventory costing attaches the actual cost to an identifiable unit of product. identifiable unit of product. Firms find this method Firms find this method easy to apply, easy to apply when purchasing, easy to apply when purchasing and selling large inventory items, large inventory items such as cars, such as cars. Under the specific identification method, the firm must identify the firm must identify each unit of inventory, each unit of inventory unless it is unique, with a serial number or identification tag or identification tag. Second point, FIFO, first in, first out. The FIFO method of inventory costing assumes 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 that the cost of the first goods the cost of the first goods purchased are charged to those charged to cost of goods sold when when the company when the company actually sells goods. This method assumes the purchased are first goods purchased are the first goods sold. In some companies, in some companies, the first units in bought must be must be the first unit sold out to avoid large losses from spoilage. Such items as fresh dairy products, such items as fresh dairy products, fruits, and vegetables should be sold on a first in, first out, that is FIFO basis. FIFO basis. In these cases, as assumed first in, as assumed first in, first out flow corresponds with the actual physical flow of goods. So that was about FIFO. Third is LIFO. LIFO, last in, first out. Last in, first out. The LIFO that is last in, first out method of inventory costing assumes that the cost of the most recent purchases the cost of the most recent purchases are the first first cost charged to cost of goods sold when the company when the company actually sells the goods when the company actually sells the goods. Point number 4, weighted average weighted average method weighted average method. Just write the weighted average method of inventory costing is a means of costing ending inventory using a weighted average unit cost weighted average unit cost weighted average unit cost companies companies most often use companies most often use the weighted average method to determine a cost determine a cost for units that are basically that are basically the same that are basically the same such as identical games such as identical games in a toy store or or identical electrical tools in a hardware store since the units are alike. Firms can assign the same unit cost to them. Firms can assign the same unit cost to them. Calculating calculating cost of goods sold period method. We have opening inventory plus purchases equal to inventory available for sale. Inventory available for sale. Available available for sale minus closing inventory minus closing inventory equals to equal cost of goods sold. Cost of goods sold, COGS. That is COGS. We have learnt about specific identification method also. Specific identification method is a measure of finding out inventory, ending inventory, closing inventory costs that requires detailed physical count. We'll go to the next question, but before that, write a note. Specific identification method is a method of finding out the ending inventory cost that requires a detailed physical count The next question is question 2. The next question is question 2. Distinguish between LIFO and FIFO basis of costing of stock. Distinguish between distinguish between LIFO and FIFO. LIFO and FIFO basis of costing of stock. Basis of costing of inventory. Make this chart along with me. Basis, LIFO and FIFO. The first basis is stands for LIFO stands for last in, first out, whether FIFO stands for first in, first out. What do we do of unsold inventory? What is the treatment of unsold inventory? Unsold inventory comprises the earliest acquired goods in FIFO. Unsold inventory comprises goods acquired most recently. Goods acquired most recently. Third point, restrictions International Financial Reporting Standard IFRS does not allow using LIFO for accounting. Whether in case of FIFO there are no gap or IFRS restrictions. There is no restrictions for using FIFO, first in, first out. Both allow this accounting method to be used. Next point, effect of inflation. Effect of inflation. Effect of inflation. If costs are increasing If costs are increasing, then recently acquired, then recently acquired items are recently acquired items are more expensive. This increase this increases the cost of goods sold COGS, cost of goods sold under LIFO, and decreases the net profit decreases the net profit. Over here, the income tax is smaller. Income tax is smaller. Value of unsold inventory is lower. Value of unsold inventory is lower. Let us stretch these lines. Let's write about the effects of inflation in case of FIFO. If costs are increasing, if costs are increasing, the items acquired, the items acquired first were, the items acquired first were cheaper. This decreases, this decreases the cost of goods sold, cost of goods sold, that is COGS, under FIFO, under FIFO, and increases profits, and increases profits. The income tax, the income tax is larger in this case, and value of value of unsold inventory is also higher, is also higher. Let us continue, stretch these lines a bit. This was point number 4. Write point number 5. Effect of effect of deflation. Effect of deflation converts to the inflation scenario, converts to the inflation scenario. Accounting profit, accounting profit, accounting profit, and therefore is lower. Tax is lower using first in first out. Tax is lower, sorry, using LIFO. Just erase it. Just erase it. Just write using LIFO, last in first out, for a deflationary period results in results in results in both results in both accounting profit results in both accounting profit and value of unsold inventory and value of unsold inventory being higher. In FIFO, just write converts to the inflation scenario, converts to the inflation scenario, accounting profit converts to the inflation scenario, accounting profit, and therefore tax tax is lower tax is lower using first in first out, that is FIFO, in a deflationary in a deflationary period, that is deflation. Value of unsold inventory value of unsold inventory is lower. Value of unsold inventory is lower. Let us stretch these lines. We have written point number 1 to 5 and just write point number 6, record keeping. Point number 6, record keeping. Over here in LIFO, since newest items are since newest items are sold first, the oldest items the oldest item may remain in the inventory for many years for many years. This increases the number of records. This increases the number of records to be maintained. To be maintained. Write in FIFO, since oldest items are sold first in first out, so oldest items are sold first, the number of records to be maintained decreases. The number of stock to be maintained decreases. Next. This was point number 6. Point number 7, fluctuations. Point number 7, fluctuations. Write in LIFO first. LIFO first. Goods from number of buyers. Goods from number of goods from number of years ago. Number of years ago may remain in the inventory. May remain in the inventory. Selling them may result in reporting unusual increase or unusual decrease in cost of goods. In cost of goods. Okay, so in FIFO, just write only the newest items remain in only the newest item remain in the inventory and the cost is more recent. The cost is more recent. Hence, we can say that there is no unusual increase or decrease in cost of goods sold. Cost of goods sold. I believe you understood this. Let us move ahead. Let's see the next question. 2.2. That is FIFO and weighted average price method of cost. FIFO and weighted average price method of stock costing. Question 2.2. FIFO and weighted average method of stock costing. The first is FIFO, first in first out. FIFO method relies on a cost flow assumption FIFO method relies on a cost flow assumption that removes costs from the inventory account when an item in someone's inventory, when an item in someone's inventory has been purchased at has been purchased at varying cost has been purchased at varying costs over time over time when a business when a business uses FIFO, the oldest cost the oldest cost of an item in an inventory will be will be removed will be removed first when one of those items is sold. One of those items is sold. This oldest cost, this oldest cost will then be reported, then be reported on the income statement as on the income statement as part of the cost of goods sold. Part of the cost of goods sold. Next point, weighted average method. Weighted average method. The weighted average method. The weighted average method, which is mainly utilized utilized to assign which is mainly utilized to assign the average cost the average cost of production to a given product is most commonly is most commonly employed most commonly employed when inventory when inventory items are so intertwined that it becomes difficult to assign difficult to assign a specific cost to it a specific cost to an individual to an individual unit to an individual intertwined is linked closely together. You can say that this can't be bifurcated linked closely together, so it can say that it can't be bifurcated. So individual unit, this is frequently this is frequently the case This is frequently the case when the inventory items in question are identical to one another, identical to one another. Furthermore, we can say that this method, this method assumes this method assumes store a store sells all of its inventories inventories simultaneously simultaneously sells all of the inventories simultaneously sells all the inventories simultaneously. Understood? Consider an example. Consider an example over here. Suppose you own a furniture you own a furniture store and you purchase and you purchase 200 chairs for rupee 10 per unit for rupee 10 per unit. The next month the next month you buy another 300 chair for rupee 20 per unit rupee 20 per unit. At the end of an accounting period, at the end of the accounting period, let's assume that you sold 100 chairs. You sold 100 chairs. The weighted average costs and FIFO cost need to be computed. Need to be computed. Weighted average cost, weighted average cost of chair equals rupees 6,000 divided by 500 equals to per chair cost of goods sold equals rupee 12 multiplied by 100 equals 1200 and remaining inventory and remaining inventory equals rupee 12 multiplied by 400 equals 4800. But before this, just make a working note over here. working note, 200 chairs at rupee 10 per chair equals rupee 2000. 300 chairs at rupee 20 per chair, 20 per chair equals rupee 6000, and total number of chairs, total number of chairs, total number of chairs equals 5. Let's do it by FIFO, first in first out. Cost of goods sold equals 100 chairs sold multiply by rupee 10 equals rupee 1000. Remaining inventory equals 100 chairs multiply by rupee 10 plus 300 chairs multiply by rupee 20 equals rupee 7000. I believe you understood this. I believe you understood this. Let us stop here. Let us stop here. We'll continue the practical questions in the next class. We'll continue the practical question in the next class. We are stopping here. Thank you. Thank you all of you.